You know what's fascinating about silver? While everyone's been obsessing over Bitcoin and tech stocks, something extraordinary just happened in the silver market that most people completely missed. And I'm not talking about some minor price movement or typical market noise. I'm talking about a technical pattern that historically precedes massive price explosions. Let me paint you a picture of what's unfolding right now. Silver just carved out what technical analysts call a bull flag pattern. Now, if you're not familiar with chart patterns, stay with me because this is important. A bull flag is essentially the market taking a breath before the next leg up. Think of it like a sprinter crouching down before exploding out of the blocks. The crouch isn't weakness, it's preparation for power. Here's what makes this particular setup so compelling. Silver rallied aggressively, pushing above $51 per ounce. That's a level we haven't seen sustained in over a decade. Then, instead of collapsing like skeptics predicted, it did something remarkable. It consolidated. It held its ground. It formed this tight, orderly pullback that technical traders dream about. But the pattern itself is only part of the story. What's happening beneath the surface is where things get really interesting. Let me take you inside the mechanics of the silver market, because understanding this will help you see why this setup is so powerful. The silver market operates on two levels. There's the paper market, where contracts trade on exchanges like the COMEX in New York. Then there's the physical market, where actual metal changes hands. And right now, these two markets are telling very different stories. The paper market shows plenty of silver available. Contracts trade freely. Prices move based on technical levels and trader sentiment. But the physical market? That's where the real story lives. Refineries are running at capacity. Mints are struggling to keep up with demand. Premiums on physical silver coins and bars have been elevated for months. When you go to buy actual silver, you're paying significantly more than the spot price suggests you should. That spread, that premium, is telling you something critical. It's telling you that physical demand is overwhelming supply. Now, let's talk about why this matters for the bull flag pattern we're seeing. Technical patterns work because they reflect human psychology and market structure. A bull flag forms when strong buying pushes prices higher, then profit-taking and consolidation create a brief pause. The key is that during this pause, the underlying demand doesn't disappear. It's still there, building pressure, waiting for the next catalyst. And the catalysts? They're everywhere you look. Central banks around the world have been on an unprecedented gold and silver buying spree. But here's what most people don't realize. When central banks buy gold, they're making a statement about the dollar. They're diversifying away from dollar reserves, and when that happens, silver follows. Always has, always will. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically elevated. Right now, you need roughly 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages closer to 60. Some analysts argue the natural ratio, based on the actual amount of silver versus gold in the Earth's crust, should be closer to 15 to 1. Now, I'm not saying we're going back to 15 to 1 anytime soon, but even a move back to the historical average of 60 would mean silver significantly outperforms gold on a percentage basis. Let me give you some context on what happens when silver really moves. Back in early 2011, silver went from around $18 to nearly $50 in just a few months. That's a gain of almost 180% in less than half a year. People who positioned themselves early in that move saw life-changing returns. And here's the thing, the setup we're seeing now has similar characteristics to what preceded that rally. What drove that 2011 move? A combination of factors. Quantitative easing was flooding the system with liquidity. Investors were terrified about currency debasement. Industrial demand was strong, and technical patterns aligned perfectly. Sound familiar? Because we're seeing all of those elements again, just in different forms. The Federal Reserve has expanded its balance sheet to levels that would have been unthinkable a generation ago. Trillions of dollars have been created, and while inflation has moderated from its peak, the underlying monetary expansion hasn't reversed. That money is still in the system, looking for a home. And historically, when investors lose faith in paper currencies, they turn to tangible assets. Gold, silver, real things you can hold. But there's another dimension to this story that most people overlook. Silver isn't just a monetary metal. It's an industrial metal. And the industrial demand picture is transforming in ways that could create a supply crisis. Solar panels use silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments worldwide are pushing, It's incredibly silver intensive. Here's a number that should make you sit up and pay attention. The Silver Institute estimates that industrial demand for silver has been exceeding mine supply for years. The deficit is being filled by above-ground stockpiles and recycling, but those stockpiles aren't infinite. At some point, if demand continues to exceed supply, something has to give. Either demand gets rationed through higher prices, or supply increases dramatically. And increasing silver supply isn't easy. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just decide to mine more silver. Now let me address something important, because I know some of you are thinking about your retirement accounts, your savings, your financial security. If you're sitting on a substantial retirement portfolio, maybe $100,000 or more, and you're concerned about currency debasement, inflation, or financial system instability, there's a strategy worth understanding. Gold IRAs allow you to hold physical precious metals inside a tax-advantaged retirement account. I put together a comprehensive guide on how this works, the rules, the custodians, the whole process. It's in the description below. No obligation, just information. Worth checking out if that's relevant to your situation. All right, back to this bull flag pattern and why the timing matters. Technical patterns are most powerful when they align with fundamental drivers. And right now, the fundamentals are screaming. Let me walk you through what's happening in different parts of the market. The COMEX, the major exchange where silver futures trade, has been showing some interesting dynamics. Open interest, which measures the total number of outstanding contracts, has been elevated. But here's where it gets fascinating. The commercial traders, the big banks and institutions that typically hedge physical positions, have been reducing their short positions. In plain English, the smart money that usually bets against price rallies has been backing off. That's significant. It suggests they see something coming. Meanwhile, the investment demand side is waking up. Silver ETFs, which allow investors to gain exposure to silver without holding physical metal, have been seeing inflows. Not massive yet, but steady. And here's the thing about investment demand in silver. It's tiny compared to gold. The entire silver investment market is a fraction of the gold market, which means when investment demand really kicks in, it can move the price dramatically because there's not that much available supply to absorb it. Let me tell you a story that illustrates how quickly things can change in the silver market. There was a period several years ago when a supply squeeze developed. Nothing dramatic, just a mismatch between what buyers wanted and what sellers could deliver. Within weeks, premiums on physical silver doubled. Dealers couldn't keep inventory. Wait times stretched from days to months. And this wasn't during some major crisis. It was just a temporary supply-demand imbalance. Now imagine what happens if we get a real rush into silver. If investors decide they want exposure. If industrial users start securing supply ahead of anticipated shortages. The price could move faster than most people think possible. The bull flag pattern we're seeing is essentially the market coiling up before that potential move. The consolidation phase, that orderly pullback, is shaking out weak hands. It's allowing late sellers to exit. It's building a base of support. And when it breaks out, when price pushes above the upper boundary of that flag, it typically moves fast. Now I want to talk about something that doesn't get enough attention, the geopolitical dimension of silver and precious metals. We're living through a period of significant global realignment. The BRICS nations, Brazil, Russia, India, China, South Africa, and now expanding to include others, have been openly discussing alternatives to the dollar-dominated financial system. They're talking about trade settlements in local currencies. They're discussing a potential commodity-backed currency. And while the details remain unclear, the direction is obvious. The world is slowly, methodically moving away from dollar hegemony. What does this have to do with silver? Everything. Because when countries diversify away from dollars, they need to hold something else. Gold is the obvious choice, and we're seeing record central bank gold purchases. But silver, as gold's monetary cousin, benefits from the same dynamic. And because the silver market is so much smaller than gold, even a tiny fraction of that capital flow can have an outsized impact on price. Think about the scale we're talking about. Global currency reserves are measured in trillions of dollars. The entire above-ground silver supply available for investment is measured in billions. If even 1% of global reserves decided to include silver, it would overwhelm the available supply. Now, I'm not predicting that happens tomorrow, but the trend is clear. Diversification away from pure fiat currency reserves is accelerating. Let me give you another historical parallel. In the 1970s, we saw a similar setup. The Bretton Woods system collapsed. The dollar was no longer backed by gold. Inflation surged, and precious metals went on a decade-long bull market that saw silver rise from around $2 to $50. That's a 25 times return. Now, I'm not suggesting we're going to see that kind of move again. The circumstances are different, but the underlying dynamic, loss of confidence in fiat currency, is remarkably similar. What's different this time is the industrial demand component. In the 1970s, silver was primarily a monetary metal. Today, it's essential for modern technology. That creates a floor under the price that didn't exist before. Industrial users need silver. They can't just stop buying if the price goes up. They have to pay whatever it costs because their products require it. That inelastic demand creates a powerful support level. The bull flag pattern is showing us that the market is recognizing this setup. Technical traders are watching, momentum is building, and the breakout, when it comes, could be explosive. Here's what typically happens with a bull flag. The consolidation phase lasts anywhere from a few weeks to a few months. Then, on increasing volume, price breaks above the upper trend line of the flag. When that happens, the measured move, the technical target, is calculated by taking the height of the flagpole, the initial rally, and projecting it from the breakout point. In this case, if we measure the initial rally that created the flagpole, we're looking at a move of roughly $15 to $20. If that projects from a breakout around $50, we're talking about a technical target in the $65 to $70 range. Now, technical targets aren't guarantees. Markets don't move in straight lines, but they give you a framework for understanding the potential magnitude of the move. And here's what makes this particularly interesting. If silver does break out and start moving toward those technical targets, it will attract attention. Media will cover it. Retail investors will notice. FOMO, fear of missing out, will kick in. And that's when moves can really accelerate, because silver, unlike gold, is affordable for average investors. You can buy a meaningful position without needing tens of thousands of dollars. That accessibility means retail participation can be significant. I want to talk about the supply side for a moment because this is critical to understanding the long-term picture. Silver mining is not a growth industry. Most of the easy-to-access silver has already been mined. New discoveries are rare, and the lead time from discovery to production for a new mine is measured in years, sometimes decades, which means even if prices rise significantly, supply can't respond quickly. Meanwhile, above-ground stockpiles have been declining. The days when governments held massive silver reserves are long gone. Most of that silver has been sold off, melted down, used in industrial applications. What remains is largely in the form of coins, bars, and jewelry held by private investors. And here's the thing about private investors. They're not sellers at current prices. Most people who own physical silver bought it as insurance, as a store of value. They're not looking to flip it for a quick profit. They're holding it for the long term. This creates an interesting dynamic. If investment demand increases, where does the supply come from? Existing holders aren't selling. Mine supply is relatively fixed. Industrial users need their allocation. The only way to balance the market is through higher prices. Prices that incentivize some holders to sell, prices that ration demand. And that process, that price discovery mechanism, can lead to significant volatility. The bull flag pattern is essentially the market's way of preparing for that volatility. It's a consolidation before the next leg, and the longer the consolidation lasts, the more powerful the eventual breakout tends to be. Because during that consolidation period, weak hands exit, strong hands accumulate, the supply-demand balance shifts, and when the breakout finally comes, there's not much resistance to slow it down. Now, let's talk about what could trigger the breakout. Technical patterns need catalysts, something that shifts sentiment, that brings in new buyers, that changes the narrative. And there are several potential catalysts on the horizon. A weaker dollar would be bullish for silver. Any sign of renewed inflation would drive investors toward hard assets. Geopolitical tensions that threaten supply chains could highlight silver's strategic importance. Or simply continued strong industrial demand combined with constrained supply could do it. The beauty of a bull flag pattern is that you don't need to predict the specific catalyst. The pattern tells you that the market is coiled and ready. When the catalyst comes, whatever it is, the market will respond. And if you're positioned ahead of that move, you benefit regardless of what specifically triggered it. I want to address something that often comes up when discussing silver. The volatility. Silver is more volatile than gold. It moves faster in both directions. And that volatility scares some investors. But here's the thing about volatility. It's only a problem if you're trading with money you can't afford to lose, or if you're using leverage, or if you have a short time horizon. If you're investing with capital you can afford to hold through fluctuations. If you're thinking in terms of years, not days, then volatility is actually your friend, because it creates opportunities. The bull flag pattern we're seeing is a perfect example. The consolidation, the pullback, the volatility during that phase. It's creating an entry point. It's allowing investors who missed the initial rally to get positioned. And historically, those who buy during the consolidation phase of a bull flag before the breakout tend to do very well. Let me give you some perspective on where we are in the bigger picture. Silver spent years in a bear market. From the 2011 peak near $50, it declined to a low around $14. That's a brutal decline. It shook out speculators. It discouraged investors. It created a generation of people who view silver as a losing investment. But that bear market also created the foundation for the next bull market. Because bear markets clear out excess supply. They discourage new production. They set the stage for the next cycle. And we're now several years into what appears to be a new bull cycle. Silver has been making higher lows and higher highs. The trend is up. The momentum is building. And this bull flag pattern is a continuation pattern. It's not a reversal. It's the market saying, we're going higher, we're just taking a breath first. The question isn't whether silver will move higher. The question is when, and by how much. And while I can't give you exact dates or prices, I can tell you that the setup is as compelling as any I've seen in years. The technical pattern is textbook. The fundamentals are supportive. The sentiment is shifting. And the catalysts are lining up. Here's what I'm watching for. The breakout above the upper trend line of the bull flag. That's the signal that the next leg up is beginning. Ideally, you want to see that breakout on strong volume. You want to see conviction. And once it breaks out, you want to see it hold above that level. A breakout that immediately fails is a false signal. But a breakout that holds and builds on itself, that's the real deal. The other thing I'm watching is the gold-silver ratio. If that starts to compress, if silver starts outperforming gold, that's confirmation that the silver story is gaining traction. Because historically, in the later stages of precious metals bull markets, silver outperforms. It's more volatile, more speculative, and it attracts more aggressive capital. I also want to mention the role of options and derivatives in the silver market. There's a significant amount of options activity, particularly in out-of-the-money calls. That suggests traders are positioning for a big move higher. Now, options can be wrong, but when you see consistent positioning in one direction, it's worth paying attention to. It tells you where the smart money thinks the market is headed. The supply-demand fundamentals in silver are unlike anything we've seen in decades. You have declining mine supply, increasing industrial demand, potential investment demand that hasn't even really kicked in yet, and a market structure that's vulnerable to squeezes. Add in the geopolitical backdrop, the monetary policy environment, and the technical setup, and you have a perfect storm brewing. This bull flag pattern isn't just a random chart formation. It's the market's way of telling you that something significant is building. It's the pause before the acceleration. And if history is any guide, the breakout from this pattern could mark the beginning of a move that surprises even the bulls. The key is positioning before the breakout, not chasing after it's already happened. Because once silver really starts moving, once it captures attention and momentum builds, the moves can be fast and furious. You don't want to be trying to get in while it's already running. You want to be positioned during the consolidation, during the flag formation, when most people are uncertain and waiting for confirmation. That's the nature of markets. The best opportunities come when there's still doubt, when the outcome isn't certain, when you have to make a decision based on probabilities rather than certainties. And right now, the probabilities favor silver. The pattern is there. The fundamentals support it. The catalysts are lining up. This is one of those moments where the market is giving you a clear signal. The question is whether you're paying attention.